Okay, so class 25 here. We want to finish up our discussion of the benefit of survivorship and then get into a really great topic, which is asset liability management. We'll be focusing a little bit here on annuities because that's really the most dangerous product that insurance companies sell when it comes to asset liability management. And then we have a math problem, which is, I think, a really good way to understand exactly what it is that the investment professionals and the actuaries do to manage something like an annuity. All right, so today we want to talk about this concept of benefits of survivorship, and we're really focusing in on really annuities. We could do this with life insurance. Life insurance is more of the benefit of dying early. So in life insurance, as we said last class, those who die early subsidize those who live longer. So with an annuity, those who die early subsidize those who live longer, and that's what we talk about the benefit of survivorship. So we're going to look at these. I set this up a little bit last class, but let's set this up. So let's say you have two products. One is, so this is the benefit of survivorship. So let's say we've got a bank CD. A bank CD does not have any benefit of survivorship. If you buy it and you die, your estate gets it. If you live, you get it. So either way, you get all the money. So on a bank CD, we want to figure out how much that might be worth at the end of the period of time. So if you buy a bank CD for $10,000 and it's returning 5%, which would be really, really nice, 1.05, so 1 plus 0.05, and we're going to do this for 30 years, then we should, at the end of that 30 years, have $43,219.42. If we do a pure endowment, so what a pure endowment does, I mean this works for annuities, but we're going to do an annuity that only has one cash flow. So if you die, you get nothing, but if you're still alive in 30 years, you get a 5% per year return, plus you get all the money plus the investment return of those who died before that 30 years. So the way we handle this is the same $10,000, and we're going to invest it at 1 plus 0.05 raised to the 30th. So that's going to be the same. That's no different than what we just saw. But what we're going to change is we're going to get that for all of the L60s. So let's put, we're doing this for people 60 years old, and I'm doing it pretty late in life because I want you to see how it impacts. It really has a huge impact if you make it pretty late in the person's life. So L60, we saw that in some of the example problems, those complicated example problems we did. So L60, and the people that they're going to pay the premium, and the L90s receive the money if they're still alive. So and so obviously the L90s are all still alive. And so what do we do there? Where our numerator is $10,000 times 1.05 raised to the 30, just like we have with the CD. But we're going to get that for everybody that's alive at age 60. But then the only people who get to share that at the end are those who are still alive at age 90. And so instead of getting $43,000, those people who make it to 90 will make $541,000. So if we look at our return here, it's pretty straightforward. We already know what it is, but we can calculate it. So return is the ending value divided by the beginning value, raised to the 1 divided by n, which is 30 years, minus 1. So obviously that's going to be 5%. We already know that. If we do that same thing here, we take the ending value divided by 10,000 and raise that to 1 divided by 30 minus 1. we still here we're getting a 14.2% return. So the annual return, and then here's what we call the benefit of survivorship. You can do it in dollars and say, wow, you get $541,000 versus $43,000, or you can do it in return. How much extra return you get? Well, 14% minus 5%, you get an extra 9.23% return. So it's huge if you live that long. Now, obviously, if you die in 29 years and 11 months, you're going to be pretty upset, because if you could have just made it a few more weeks, your estate would have gotten to $500 and something thousand. But I really believe they need to be set up like that, even with that cliff. But that's the benefit of survivorship, is you have a lot of people alive at the beginning of the period, not many alive at the end. Very similar to life insurance, where you have very few people die and a lot of people that are alive, so you have a lot of money to split between the few people who die. Same thing here with the annuity. You have a lot of people whose money you can split with a few people who are still alive in 30 years. So this is the product I like. If you expand the time, you buy it at 25 and go to age 95, and we saw some of that in the example problems we did, then you get a much huger payoff, because at 25 you have 100,000 people based on our table, and at 95 you're only going to have a couple of thousand people. So there's like a 50-fold. If we look at it, we can do it. Let's give ourselves another practice at this. L95. So L25 is 100,000. L95 is only 1,500 people. So you're going to get more than the 50-fold increase in your return. And so your ending portfolio, if it's a CD, you just make $50,000 or $5,000 times 1 plus 0.05 raise, and here it's 70 years. So the CD would be worth a whopping $150,000. That's great. But what about the endowment? Well, here's the same math again. The exact same math is here. That doesn't change. But the difference is we multiply that by the L25 and we divide it by the L95. And so that means these people, instead of getting $152,000, they're going to get essentially more than 50 times that. Why? Because 100,000 divided by 1,500 is 66. So you get 66 times more return. If you look at the return, we already know what this one is. 152,000 divided by $5,000 raised to the 1 divided by 70 minus 1. Obviously, that's going to be 5%. We do that for the endowment. It's 11.74%. Pretty amazing return. The dollars look much bigger, but the return doesn't look as big. The difference in return, but it's a huge, and it really has to do with, the compounding over time has bigger impact on the dollars than it does on the return. But still, that's a huge benefit. So just think about this. You've got people, the 25-year-old doesn't make as much sense as a 60-year-old, but you got a bunch of 60-year-olds who are not prepared for retirement. They're going to run out of money if they make it to age 90. So you have this product that if they're living at age 90, they'll get $500,000. If they don't make it to age 90, they get nothing, but they only have to invest $10,000. So let's say they have $300,000 in their portfolio. They take $10,000 of it and they invest in this product. Then if they live past 90, they get $500,000, which is really going to help them a lot those last few years of their life. If they don't, they lost $10,000, but they're okay because they had $290,000. They had $300,000. They spent $10,000 on this annuity. And essentially, the question I ask is, where in the world could you possibly go to get a low-risk portfolio that guarantees you a 14% plus return over 30 years All you have to do to get it is to live. So this is the product I was pushing at UTSA. It was actually a combined product. I know on your paper one you talked about some product ideas at the end of that third article on annuities. I don't like those ideas necessarily. I like this pure endowment approach. So the product I wanted to develop, the reason actuaries don't like these pure endowments because they think people are thinking in an investment standpoint that they're going to lose 100% of their money. But my idea was if you did this from a portfolio context, you got the 50-year-olds, you maybe have a couple of $100,000 saved up, and you say, let us take your portfolio, and what we're going to do is we're going to maximize it. So we maximize the income during your retirement years by using a combination of investments plus these pure endowments. And so that they don't see it in the investment context, they see it in the consumption standpoint. What's going to give you the maximum income over your retirement years? So I think it could work as a product, but I just haven't seen a company try it. If any of y'all want to start your own insurance company to sell a product like this, boy, I'd be a free consultant. You'd have to hire some actuaries. It wouldn't be quite as favorable as this because we're using the 1980 CSO table, and so it's a regulatory table, and people die much faster in that table than they do really. So this difference between 25-year-olds and 95s is probably not quite that stark, although once you get up into the 90s, it's not going to be radically different. People are living longer, but there's still a pretty huge difference. So it'd still be pretty stark. It may not be 10 million, it might only be 9 million, but it's going to be a pretty stark difference. So that's the benefit of endowment, of survivorship. And we kind of saw it when we were doing some of these long problems, like some of these, where we just saw, wow, what an incredible benefit. You know, they pay a $10,000. Well, that's the joint annuity. Here's this one. So I really like this one. Y'all might remember this one, but this is one where everybody gets all of their money back. So people pay a premium age 35. It pays $50,000 to anyone alive at age 60. Otherwise, it pays the original premium back. So that means at age 60, everybody either gets $50,000 or they get their original premium back. Their estate does. Then it pays $5 million to people at age 90, and that premium, I forget what the premium actually was, but let's see, the premium of $35,000. So they pay a $35,000 premium, and their worst case is they'll get $35,819 back at age 60, or they'll get $50,000 at age 60, and if they make it to age 90, they'll get another $5 million. I think even people thinking in investment context that the worst they can do is make 0%. A lot of people, that psychologically is still a okay number. It shouldn't be. Over 25 years, that shouldn't be an okay number. But for a lot of people, that is. And that's part of that benefit of survivorship. You're taking advantage of all those people dying to help subsidize the few people who live. And that's what we need when we have a retirement crisis. And you need some money to somehow to get to the baby boomers as retired. I think a product like this would be perfect. All right, so we've gone through all the pricing examples. So we'll talk more as we get closer to the exam, exactly how to put this together for the exam. You definitely want to show all your work, although I don't have any problem doing these problems in Excel. You just want to make sure you write out the equation as you go. So get some practice doing that. So the next topic, one of my favorite topics, this is really my whole career for the most part, is asset liability management. ALM. There are other terms people use like balance sheet immunization, which we tend to use that with pension plans, but it's the same thing. It's managing your assets and liabilities in a way that you protect the firm's net worth. So up to page 70 of the notes, asset liability management is assets minus liabilities is net worth. So asset liability management is really net worth management. And remember, for insurance companies, net worth, we sometimes call that capital. So capital management, I was in a department for several years called capital management. I worked very closely with departments called ALM. There's a department at UTSA in the life insurance company called Asset-Liability Management. Small department, really brainy people, extremely good with computers because they ran a lot of simulations, and we'll show you some of the results of those simulations. That's really what you're doing. So my department called capital management, we were really doing asset liability management. We just didn't call it that because we're trying to protect the net worth of the firm. Well, you do that by making sure assets and liabilities move in a way that you don't risk losing the entire firm. So for most firms, as we've said previously, capital usually means debt and equity of the firm, but for banks and insurance companies, capital really means the net worth of the firm. And that's because most banks and insurance companies really don't use debt. Their customers are their debt. They essentially borrow money from their customers. And so their net worth is their true outside capital of the firm. So capital management is managing assets and liabilities together in order to protect net worth. So the key is what drives your assets, what drives your liabilities, what's the link between those? So you look at mortality. Mortality definitely drives your liabilities. If more people die for life insurance, you're going to have higher liabilities. If fewer people die for annuities, you're going to have higher liabilities because you have to pay out longer. But that doesn't give you the link because mortality doesn't affect assets. It would take a huge event that would be seen in the life insurance deaths. That would also be a big hit to the assets of insurance companies. Now, on the property and casualty side, it's possible some major hurricane or earthquake could move markets. I know in Japan, when they had their big earthquake, it definitely had an impact on interest rates. But for life insurance, I can't think of an event, even COVID-19, with an extra few 100,000 deaths. Even that has not had a huge impact on the life insurance industry. So it definitely affected the markets, although they've come back pretty strong since. But the markets weren't reacting to the fact that a higher group of people were dying, more people were dying, but mainly because of the economy being shut down. But it's hard to get that link. 2020 was a very unique year, and it's hard to say you're going to manage a company going forward based on that one year. Inflation is not an issue for life insurers. Remember, when life insurers pay life insurance, there's a face amount that doesn't change with inflation. It's always the same amount every year. And annuities are generally not adjusted for inflation. I know when you're doing paper one, some of y'all mentioned that the author talked about with the risk of inflation for people wanting to buy annuities. That fourth article, he mentioned, well, the one way to protect yourself from inflation is to buy inflation-linked annuities, but they're not that common, especially now that inflation-linked bonds have such ridiculously low yields. It's really tough to manage that. Now, property and casualty companies, inflation does affect both the assets and liabilities, not in a way that's predictable and easy to follow, but property and casualty companies do make investments in assets that they believe will help protect them from inflation. Most importantly, P&C companies buy a lot of stock, common stock, where life insurance companies do not buy common stock. And the argument P&C insurers make for buying common stock is that it can be a good hedge for inflation. That's not necessarily true in a decade like 1970s when it's really hyperinflation. But normal inflation, stocks will do better than bonds. So that's really not it. You can't link assets and liabilities for an insurance company by trying to look at inflation. So the key for life insurance companies and banks as well is interest rates. Interest rates is the one thing that has a close tie to the assets and liabilities. Now banks, there's also a tie with banks with their bad loans, their bad debts being tied to the overall economy. But banks tend to have fairly conservative and basic balance sheet investments, whereas life insurance companies have much more complex and much more difficult to manage assets. So really, interest rates is the key thing we're looking at here. And life insurance companies usually don't have liabilities that are that closely tied to the overall economy, except for through interest rates. When the economy is weak and interest rates fall like they have this year until just the last few weeks, yeah, you'll definitely see a link between the economy and falling interest rates. But that's the key. For asset liability management for banks and life insurance companies, the real key that links everything together is interest rates. And that's the reason why if you became a life actuary and you worked in this asset liability management area, you would become an absolute expert on interest rates and interest rate theory, interest rate modeling. I could maybe send the actuaries some example models. I'm not an expert in the math behind these different kind of arbitrage-free types of models for interest rates. Hopefully you're seeing some of that in some of your classes, or at least we'll get some exposure on the actuarial exams. It's a great area to work in because you do have to specialize so much in that one area. And so the math is really fun and real advanced. So yeah, life actuaries tend, especially on the ALM side, tend to understand the bond market interest rates far better than bond investment professionals. So interest rates impact both assets and liabilities. And insurance companies, life insurance companies, do not have a lot of net worth for every $1 in assets. Here's the balance sheet for MetLife. You can see their total assets are $740 billion, and their net worth is only $66 billion. They're not even 10 to 1, and they've never been 10 to 1. In fact, look, I mean, it's just pretty amazing. So 740 to 66, I mean, that's like 12 to 1 or something. It's a pretty big difference. So very leveraged firms, which means your assets don't have to fall much to wipe out, a 10% fall in assets and you lose all of your net worth. So extremely levered. This is not true for property and casualty companies. Well, not true. Let me bring in, what's it good? Let's try Chubb. So when we look at Chubb, you can see much more balance. I mean, Chubb has almost the same net worth as MetLife, but only about a fifth of the assets. So that's more like 3 to 1 or 3.5 to 1 or something versus 12 to 1. So life insurance companies are much more levered than property and casualty insurance companies. So where does this leave us then? So it doesn't take much to wipe out the net worth of a life insurance companies. So if assets fall 5% and liabilities fall 6%, they can't handle it. That's too much. So what we need is something that when liabilities are rising, assets must rise. It's okay if assets and liabilities both fall because then your net worth is okay. What we can't have is assets falling and liabilities rising. That would be a disaster. So here's the scenarios. Liabilities rise, asset rise, everything's fine. Assets fall, liability falls, everything's fine. Here's asset rise and liabilities fall. That's unattainable without taking a lot of risk over here. It may be nice to have your assets going up and your liabilities falling, but that's just hard to create without creating this risk of assets falling and liabilities rising. And that's an absolute disaster. So our goal is to find assets and liabilities that move together. That is to be in this green box. I mean really well together because we're so heavily levered. So to protect net worth, the company wants to do balance sheet immunization, or the insurance industry, life insurance just calls it asset liability matching. So ALM can mean asset liability management, asset liability matching, M-A-T-C-H-I-N-G, and asset liability modeling. We use ALM. I've heard people say ALM modeling, so you kind of have a double M in there. But the M can be management, matching, or modeling. Pension world uses the term balance sheet immunization. I've heard people talk about defeasing the balance sheet. You cannot do that with life insurance companies. Defease means you completely eliminate the risk. So the defeasing would be you owe someone $10,000 and you have to pay them in 10 years. So you buy a low-risk investment that will mature at exactly $10,000 in 10 years. So when 10 years comes around, an asset matures at $10,000, you pay this person $10,000. There is no risk. You don't have to worry about what interest rates do. It's a zero coupon bond, and it just, all it does is you pay the $10,000 in 10 years. That's the feesing. Life insurance, there's a lot of assumptions. You got to decide, when are people going to die? How many people are going to surrender their policies? And you got disintermediation risk. You got to look at what bonds you're buying. You have some credit risk in there as well with bonds that you bought. Maybe the company goes insolvent. So it's tough. So the players here are actuaries and the investment team. I've worked a lot with both of those teams over time, and boy, I love this problem. If you're an actuary, it is a wonderful area to work because of the specialization and the fact that it's so complicated that if you really do your job well, you can add tremendous value to the firm. I remember at UTSA, a guy named John ran their team on the actuary side, and boy, smart guy. Really impressed what he did, but he didn't have it perfect because he didn't know exactly what would happen in different environments. They had to guess, if interest rates rise or fall, what would the customer actually do? Would they surrender the policy or would they stay pat? So he had to make up those assumptions. But I think probably in the entire country, he was one of the most sophisticated as far as going to the investment team and telling them exactly what kind of bonds they needed. And it was really quite impressive. The investment team, it was just hand in glove the way those two areas work together with each other. I actually interviewed with an insurance company in Chicago, and they didn't offer me the job. When I found out they were going to offer me the job, I kind of laid into them some, because what I noticed, it was on the investment team for a life insurance company, that no one on their investment team knew any of the actuaries working for the company. And I just had to say, how can you possibly not be talking to the actuaries if you're on the investment side? So those two groups work closely together. So I was on the investment side working on these problems, but getting to work with the actuaries, realizing the math was pretty complex, a lot of heavy IT as well, programming, and but boy, it can be a great career. It really is extremely important to the financials of a life insurance company. So let's talk about the risk of insurance companies. So insurance companies, let's talk in terms of interest rates. So insurance companies are exposed, especially on the annuity side. So we're talking life insurance companies here. They're exposed to interest rates rising, and that is a disintermediation risk. We talked about that even on exam 1. We had that question about disintermediation risk. When interest rates got really high in the late 70s, a lot of money left the life insurance industry and went over to banks. So that's rising rates. You have to look at duration. Duration just tells you how sensitive things are to changes in interest rates. So duration just gives you the formula. You can use it in the formula that says percentage change in a price of something. So here in this case, the price of the bond is minus duration times the change in interest rates and the change in yields. That's a formula every finance student, every actuary should just know. It's such an important formula. It's a straight line function. Bonds don't really move in a straight line function. They move in a convex way, but it's a good basic way to understand how bonds and interest rates work. So if a bond has a duration of 1 year, it's going to be very insensitive to changes in interest rates. So if interest rates were to go up 300 basis points or 3%, that bond price would only fall 3% if its duration was 1 year. But if the duration were 10 years, if interest rates rise 300 basis points, that bond's going to fall 30%. So duration is important. And then convexity. Life insurance bonds and liabilities have convexity. And what convexity means is how does duration change as interest rates change. So the change in a bond price will not be a straight line like duration. It will be somewhat convex. Well, life insurance companies have liabilities that are extremely convex, especially deferred annuities. So when interest rates fall, their value doesn't go up in a straight line like duration. It actually kind of rockets up. And I'll show you a picture of this. Now it's also a risk on the downside. We'll talk about that on the downside. But when you look at the risk of interest rates, life insurance annuities look like a short straddle on interest rates. So what exactly is a short straddle on interest rates? So let me show you the math here. All right, so let's say we have a stock. let's do MetLife since we're doing the life insurance. It doesn't need to be a life insurance company, but let's do MetLife. So if I bring in MetLife, I can click over here on options because straddles have to do with options. I'm going to jump out a few months. Let's go out to March. And so what a straddle is, or a strangle, they're very similar. What a straddle says is you're going to sell a short straddle. So we're selling a straddle. So I'll start with a long straddle. A long straddle is you're going to buy a call and you're going to buy a put on this company's stock. So let's start with the calls. We're going to do a call at a strike of 47.50. With a strike of 47.50, it's going to cost me to buy this $2.93. So if you look at this, the last price was 46.17. This is 47.50. So you have the right. The way a call option works, it gives you the right to buy something at some strike price. So here we're going to have the right to buy MetLife stock for 47.50, but it's currently trading for 46.17. So if the price never changes, we never execute that option. Why would we buy MetLife for 47.50 if we can buy it today at 46.17? However, if the stock jumps up to $50, $60, we have the right to buy that stock for 47.50, and then we can turn around and sell it for $60. That's going to be worth a lot to us. Same thing on the put. We'll do a put at $45, and a put at $45 is going to cost us $3.40. So let's set this up into Excel. So the call is going to cost us $2.93, strike of 47.50. The put is going to cost us $3.40, a strike of 45. So let's look at, and this is March 2021 is when it matures. So let's look at this at expiration. And let's ask, we saw a little bit of this when you did the equity-linked annuities on the first exam. But let's ask, what if their stock's trading for $25? What if it's trading for $27.50? And we'll just come all the way down to, who knows how far down we'll go. We'll go out to $75, all right? So the gain on the stock, the current stock price, let's say, is $46.50. Let's just make it a nice round number. If the stock's trading for $46.50, then at the expiration it's worth $25, and we bought it for $46.50, we lost $21.50. And you just see as the stock price goes up, you start making money. And so there's the upside and the downside. Well, let's look at the call option. The call option, the gain on a call option, is going to equal the max of the current stock price minus that strike price, $47.50, and 0. We can't have it be negative. And then we'll subtract from that the call option premium. So here we have a strike of $47.50, and our premium was $2.93. So the value of this is going to be the max of the current price minus the strike and 0. So here the value is 0 because we're not going to execute this option. But it's going to cost us $2.93 to put it in there, so we do that. And here we just lose $2.93. That's the worst we can do, but over time we start making money. We talked about this earlier in class. So you essentially have that hockey stick we saw with the equity-linked annuity. All right. Same thing with the put. The put option. The formula is almost exactly the same on a put option, except we switch them. On a put option, it's not the stock price minus the strike, it's the strike minus the current price. So here we'll do equal max, and here we'll do the strike price first minus the current price, comma 0. So that's going to be a lot of value. We can sell, so put gives you the right to sell. So we can sell this stock for 45 bucks, and at expiration it's only trading for 25. That's going to be worth 20 bucks to us. But we had to pay $3.40 to get it. So there we make money. The worst we can do is lose our premium. So we put those two together, and we do. This is really a strangle or a straddle, either one. A straddle is when you're right at the money. So the stock's trading for $46.50 and your strikes are $46.50. We couldn't do that because that didn't actually exist. So our strangle is we just add these two things together. And there's our strangle, and it's going to look, if I graph this, it's going to look kind of like a U or a V. So this is how a strangle and a straddle looks. So a straddle will have an actual V shape. It'll have a point because everything's right at the money. A strangle will have a little bit of a bowl to it. But if the stock price really falls, you make money. If the stock price really rises, you make money. The only time you lose if the stock price doesn't move much. So that's what a straddle looks like. Well, life annuities look like a short strangle. That is, you don't buy this, you sell it. When you do this picture, it doesn't look quite so exciting. Here you make money as long as the stock price doesn't move much, but if the stock price moves, you lose a lot of money. So this is what we call a short straddle or a short strangle. I'm really not all that picky about which one. You probably use the word straddle if you're in an interview, even though it's not probably technically a straddle. All right, so that's to understand. Now, you don't need all these option formulas to be able to discuss this, but a short straddle or a short strangle is like you sell a call option, you sell a put option. If the stock price doesn't move much, you make pretty good money. You get to keep it all, and you didn't invest anything, so you get to keep the what is that, $6.33. So my argument here is this is what an annuity looks like. And let me demonstrate this to you. When you have the assets and liabilities for an annuity, this is for an annuity, this is what the assets, the red is what the assets do when interest rates rise or fall. So here's our starting point at 6%. And interest rates fall, interest rates rise, that's what the assets do. Here's what the liabilities do. And you'll notice, you know, duration should just be a straight line, but when you add convexity, you get some curvature to it. You'll notice that the liabilities for life insurance companies are extremely convex, and we talked about that on exam 1. When rates rise, they don't fall in value as much as you'd expect because we have disintermediation risk. People move over to other products. When rates fall, you're crushed because you have these guaranteed minimums that you have to pay. So the liabilities are really, really, really skewed, very convex, and you cannot find assets that are as convex as the liabilities. It's just very, very difficult. So assets minus liabilities is net worth. And so this is what, when you run scenarios, what happens if its interest rates fall, what happens if they rise, this is what the net worth looks like for an insurance company. And look how much that looks like a short straddle. Now this curvature will move to the right as interest rates rise. So if interest rates keep rising, this whole thing will start shifting and you'll get more negative over here. So I kept it here where we're at. We're already kind of at high interest rates and not be exposed to rates falling more than rising. I remember the first time we showed this to our CEO, the UTSA CEO, not of the life insurance company, but of the entire company. We're letting him understand our interest rate exposure throughout UTSA. He looked at this product and said, why in the world would anyone ever want to sell this? And the actuaries had explained to him that, well, this area where we're making money, we're actually doing really well. It's actually a really high returning product. It's making us 16, 17, 18%. So it's a product that does extremely well unless interest rates move a lot, and then it can really crush you. And so, yeah, we had to kind of settle him down. He was pretty upset to say, why would I do something like this? Obviously, interest rates have fallen quite a bit, so this industry has really been struggling. Banks have been struggling as well when interest rates are really low. Banks also do very poorly in this type of environment. The best environment for banks and for life insurance companies would be for interest rates to rise some, banks would do well if they rose real quickly. Life insurance companies would do well if they rose slowly, because you don't want with life insurance for the rates to just shoot up really fast, some inflation scare, because this whole thing will start shifting down and be going off the chart over here. So what happens when interest rates rise a lot? Why is this such a terrible looking picture? Well, the portfolio yield rises slowly over time on your bonds because you bought 5 and 10-year bonds. So you bought a bond yielding 6% and now interest rates rise to 9%. You still have that 9% bond, that 6% bond. So just because interest rates rose to 9%, you're not going to make 9% on your portfolio. It's what we call a portfolio yield. It's the yield of portfolio, what includes bonds we bought 5 years ago, 10 years ago, that may not be maturing for another 5 or 10 years. And so when interest rates rise, those bond prices will actually fall in price. That's the big advantage banks have, in that their assets will move much more quickly with interest rates, because they have auto loans, they have their mortgages that they do, they get those off the books pretty quickly. They have credit card loans. Those tend to they just increase their rates whenever interest rates rise. Now, auto loan, you say, well, rates go up, so your auto loan, you're only making 4% and rates went up. But auto loans are usually only 4 or 5 years long, so they're pretty short already. Versus a life insurance company, you might have an annuity that's going to sit there for 25, 30 years. So you get that disintermediation. We already talked about that, going from insurance companies to banks. Insurers see their policyholders surrender their policies. They're taking their money out. They have to sell these bonds that are now underwater. They actually have losses on them because interest rates have risen. So what do? You can invest in shorter term investments, but that's going to be bad if rates fall. So we'll see the other side of this. You can put restrictions on withdrawals, like surrender penalties. But most of these companies did that, but these policies, the surrender penalties fall every year. So they start at 12%, then 11, then 10. So after 12 years, they're zero. And I remember when I was at UTSA, we had what we called our legacy portfolio. And these were annuities they had sold back in the 80s and when interest rates were much, much higher. And now all their surrender penalties were gone. And this was back in the mid, 2008, 2009. These legacy portfolios were $2-3 billion. They were huge. And they had these policies with these high minimum guarantees. But people could take their money out with no penalty whatsoever and move over to a bank if they wanted to. There might be some tax penalties, but there would not be any penalties from the insurance company. So those are the legacy annuities. Insurance companies still have these things. They have no surrender fees, high minimum crediting rates. One thing a lot of insurance companies have started doing, and I don't think we ever did this at UTSA, but they have what they call market value adjusted annuities. What these are annuities that when you surrender them, there's a formula that says, okay, if you surrender this when interest rates are high, your surrender penalty will be based on the fact that you're essentially chasing hot rates. You just want to take money out of this annuity and put it into high rates. So we have the right to take a surcharge that essentially penalizes you for taking out that annuity when interest rates are high. Rating agencies love this because it really protects the firm from that negative short straddle that you saw. So yeah, it's a tough essay question on the last exam, but just how do you bring all this together? So it's interesting, really interesting stuff. If you can understand this, boy, you will sound like a genius in an insurance company interview. What about when interest rates fall? Well, bond prices rise. That's good. The liability value is going to rise as well because you've guaranteed this person a return, and they're still getting that good return because you haven't invested in the bond market. But at some point, rates fall and they stay low. You start hitting your bond portfolio starts maturing and rolling over at lower rates. So this is like the worst case scenario that life insurance companies are in today. When interest rates have fallen a lot, have stayed down, they're now having to pay a guaranteed minimum that's pretty high. Now, in the 1980s, the guaranteed minimums required by state law were as high as 4.5% because state regulators in the late 70s, they said, oh, interest rates will never get below 5-6% again. So you should guarantee a minimum of 4.5%. Very short-sighted regulators. And so those legacy annuities were guaranteeing a 4.5% payment, and then interest rates fell down to 2 and 3%. Oh, those policies were just absolutely destroying insurance companies. The company I worked with, they were begging their employees to switch to another product. They would pay the worst rate they could get away on these products. So if they saw that 4.5% minimum coming, and they had other products paying 5.5%, they might cut their rate down to 4.7% on these products, even though it wasn't competitive, just to try to get the customers to get out of these products and move to another product. So today, most products use floating minimum rates, but however, I bought some annuities, deferred annuities, that still have, they have 3% floors, and I just think, man, 3% floors still sounds really rich to me. And those things have been a great product for me for a small portion of my fixed income portfolio. When the 10-year Treasury is well below 1%, for me to have something that's very low risk, tax deferred, that's guaranteed to make me at least 3% a year, yeah, that's not a bad thing to put money in. So the second risk of insurance companies is credit risk. So credit risk only affects the assets, doesn't affect the liabilities. And so, it's very similar to banks. Banks have assets, loans that are very affected by credit risk. Life insurance companies have corporate bonds, and because they have corporate bonds, those corporate bonds can go in default. They may have some collateral, so they may be protected there, so they may do some commercial mortgages, but essentially they have credit risk, and the credit risk does not impact the liabilities at all. Just because an insurance company loses money on a bond doesn't mean they can just take that away from their policyholders. So how do you handle this? I'll show you how it's handled with what we call haircuts. You set aside money just in case you go into a crisis. So that you have something set aside for defaults on your bonds. Now, 2008 was a really tough year because Treasury bonds were up 15 to 20%, but corporate bonds were down 15 to 20%. It was really one of the worst situations we had. So there were some life insurance companies that were seeing some, even though interest rates were down, so their liabilities were, definitely getting close to guaranteed minimums, they were actually losing money on their corporate bonds because credit spreads gapped out so much. So insurance companies have credit risk that only affects the assets, and that's a tough risk. Then you have mortality risk that only affects the liabilities. For life insurance, it's dying too early. For annuities, it's living too long. How do you manage this risk? You have a few extra reserves. You can buy reinsurance. You really only do that for life insurance. We have had some catastrophes, the plague, swine flu, Ebola. I don't even have COVID-19 on here because I don't know how big of an impact it had. I remember at USAA after 9/11 that they did actually notice 9/11 because USA insured, especially in the Pentagon. So they did have a little bit of spike because of 9/11, so pretty tragic. But even as tragic as those events are, they tend not to topple insurance companies. Insurance companies tend not to go under because a lot of people died more than average. So I doubt COVID-19 is a material impact on their credit losses. The question is, can you hedge this? So the question I had from a life actuary I thought was really interesting is I was managing USA's pension plan, where there we had the risk, which it's essentially an annuity. We had the risk that people would live too long. And he was insuring USA's employees with USA, every employee got one-time salary, free life insurance. He was worried about people dying too soon. So he asked, can we hedge these two risks? So, if fewer people die than expected, we'll donate money into your pension plan. If people live, the other way around. Too many people die early, that helps my pension plan because we don't have to pay out the pension. So we pay money to the life insurance company. If very few people die, so people are living longer, that's great for the life insurance company, but it's bad for the pension plan, so they would pay me money. It was interesting. The problem I had with this was the basis risk. The employees that we gave one-time life insurance to, those were active employees that were on the job now. The pension plan were for those employees who retired from USAA, so there were actually two different groups of people. So it was unlikely that would have actually worked. it's a tough risk to hedge. You're almost going to have to just buy reinsurance, and most companies do buy reinsurance. So before we get into, we're going to look at this asset liability problem. Before we do, we have to understand risk-based capital. And risk-based capital is a charge that you have based on the type of risk that you have that's going to impact how much net worth you need. And so your return on equity is going to be directly impacted by how much risk-based capital your company needs. So there's risk that we call C1 risk. That's related to credit risk and asset risk. We have C2 risk, that's insurance risk. Since we're talking about annuities, we're going to ignore C2 risk. And then C3 risk is interest rate risk, which we just said annuities have a lot of interest rate risk. So, you know, this is a very competitive product. I've been in meetings. I used to sit in a lot on the life insurance ALM committee meetings. And the president of the company would always say, come on, bond investors can't give me higher yield. We're not as competitive as you want to be. We want to pay higher rates to our customers. Well, you tell a bond investor to get higher yields, you're also telling him or her take more risk. So, so yeah, it's pretty dangerous. We're going to talk about what can you do if you can't meet the standards. So this list right here, we'll come back to it. But what if an insurance company cannot meet its ROE target? You can tell the bond investor, get me more yield, but you're just going to take more investment risk, either interest rate risk. You know, you can sell some convexity and have a lot of convexity risk. You can lengthen duration and have duration risks and be mismatched. You can buy less liquid assets. That's what a lot of life insurance companies do. But that has its own risk, especially in a year like 2008 or 2020 when markets freeze up. You can change your RBC target, but if you do that, you don't hold as much net worth. You can be downgraded. You just become more risky, and so your ROE standard is going to go up. So we'll talk about that. We'll see it in the numbers. You can reduce your crediting rate, pay your customers less. That would help, but then you're not going to be as competitive as you like. You can cut expenses. Well, yeah, you should always be doing that. If you can get more productive, you should do it. You can change the haircut. We'll look at the haircut on bonds, but then you're just kidding yourself. Are you going to lose some money on some bonds because of defaults over time or not? And if you are, changing the haircut won't change how much you're actually going to lose. So you're kind of just kidding yourself. You can change your target ROE, but your stockholders, if that's the return they require, and you don't produce that return, they're just going to kill you on the stock price. The stock price will fall. Or you can change the product itself. We talked about up here earlier. We talked about, it's way back up here. Market value adjusted annuities. If you had that type of protection, then your C3 charge, if you remember, C3 is the interest rate risk charge. So if you had a product with that kind of, sorry, I got to find these things. With high C3 risk, you could change the product to give yourself more protection, and then you wouldn't have to worry. You could definitely get the same ROE. The problem is the product may not be as competitive then. Your customers may not like that restriction. All right, so what we want to do is work through this problem. I'll do a couple of these. We'll get through one very quickly today. This will probably be too fast, but we'll get through it. But this insurance company, I built this years ago, and interest rates are much, much higher than they are today. So you're going to see it gets a little trickier. The numbers in blue are the ones I give you. The ones in red are the ones you have to calculate. So I give you the yields on these different assets, treasuries, AAA, BBB, and high yield. I give you the capital charge, which is the C1 risk capital charge. This comes from the regulators. And this company wants to have 150% of what the regulators require. So the capital charge for treasuries is 0 because they don't have credit risk. AAA, it's very, very low, 0.3%. We want 150% of that, so we have a capital charge of 45 basis points. Triple B is 4%. So when you adjust it for your capital requirements, that gets you up to 6%. And then high yield, which are the most risky, have a high risk of default, 30% capital charge. And then our C3 risk, I keep it really simple. It's just a 1% charge. You want 150% of that, so that's just 1.5%. We're not doing any C2 risk. Remember that is mortality risk. And we're doing annuities, so we're not looking at the mortality risk. So C1 risk, you're just going to take, this is a $100,000 policy. Someone walks into your company and gives you $100,000 for an annuity. So how much C1 you need to pick up? Well, it's going to be $100,000 times that capital charge. So you can see for the high yield, it's just $100,000 times 30,000. Your C2 is all zero. Your C3 is just $100,000 times a 1.5%. So there's your total required capital. And then I gave you a few other assumptions here. Our crediting rate, we want to pay these people 4.7%. That's based on our competitive pressures. The company I worked at, they did surveys, and they always wanted to be in the top 25% on their products. So that's how they got their rate. The expense load, that comes from the CFO area. They have an expense load of 1.4%. And that's just to cover their expenses. Their haircuts for triple B bonds is 1.1%. So what that says is every year they want to take out 0.1% and set it aside just in case there's a default. And for the high yield, their haircut is 2%. So I gave you some historical numbers. It's kind of dated here. It's like 10 years old. I need to update this. But it just shows you the average defaults. This is an old study. One of these days I have to update it. But here's the average default, and then when you default, you get some recoveries back. And so if you look at this over time, triple B, it's like 0.7%. So that's what you can lose on average. You look at historical. You get some years where no one defaults, but you get some really bad years. Obviously, the 2008 crisis, you had some really high defaults. But on average, it's about 10 basis points. And then below invested grade, it's like 1.78%. So we're using 0.1% and 2% just based on that history. Now, how do you tell the difference between the capital charge for high yield and the haircut for high yield? Well, the capital charge is supposed to protect you from an extreme situation, a 1 in 50-year event or something along those lines. The haircut is supposed to protect you and just average what an average loss is. So you want to make sure you don't pay your customer that 2% because on average you're going to lose that from those bonds because some bonds are going to default. So the net worth requirement is a worst case scenario. The haircut is kind of an average that you want to set aside each year. And then what you do, we're almost out of time, but my last class only went about 45-50 minutes, so we can go a little bit over an hour on this one. So essentially what you want to do is to set up an income statement. Revenue, net revenue, the haircut, your expenses, the first expense is your crediting to your customer, your other expenses, and then your net income. So let's work through each one of these and just look at them. So the Treasury, you have $100,000 and the Treasury makes you 5%, so you got 5% in revenue, no haircut because it's not going to go default. You're paying 4.7%. That's our crediting rate. You notice that's the same all the way down. Our expenses are 1.4%. That's all the way down. So $100,000 times 1.4%. So our net income is just our investment earnings minus everything else, minus the haircut, minus the credit rate, minus expenses. So you can see with Treasuries, you cannot make money in the life insurance business if you buy Treasuries. Their yields are just way too low, especially now. So your return on equity, you just take your net income, divide it by your capital requirement. Your capital requirement is really small for Treasuries, but that doesn't matter because you're losing money. Now, if we do AAA securities, we'll make 6250 to 6.25% times 100,000. We'll make that. No haircut because they're high quality. Credited rate, expenses are the same, so we make $150. Our return on equity is 8%, but they need to make 15%. So that's not going to work. Then we get the triple B. Triple B, we're making more income, $72.50. We have to set aside some just in case some of these go in default. We expect about, on average, $100 in net losses because of defaults every year, so we'll set that $100 aside. Crediting rate expenses are the same, our net income. is 1050 in that case. So we take 1050 divided by 7,500, we make 14%, not quite what we need, but getting close. And then high yield, we make 13,000, but we have to take 2,000 away because of average losses. Our crediting expenses are the same, so we make 4,900. We're going to take that and divide it by a really large number because of the 30,000 we had to set aside here. But we do beat. Now, so what do you do here? Do you say 50% triple B and 50% high yield? That will not work. You get in trouble. It's very dangerous to go over 10% in high yield. Just way too dangerous. So very few life insurance companies will do more than 10%. So you're not going to meet your 15% target. You just can't get there. But remember that list we just talked about. So you can stretch for yield, find some way to get a higher return on triple B. And I remember that was a discussion every time we had a meeting. It says John was the portfolio manager. Another John is interesting. The ALM actuary was named John. The investment guy was named John. So he was always, they always say, John, can't you get us more yield? Why can't you get us more yield? Well, if he did it, he can't do that without taking more risk. There's not just bonds sitting around with these high yields that are low risk. So I remember the funniest thing to me was he bought some bonds that had some extra yield. They had some credit risk, and the people in the committee were like, that's great. That's exactly what we want you to do. And then those bonds, as predictable as you would imagine, those bonds blew up in 2008. And boy, that committee was like, why'd you buy those bonds? The same committee that was pushing him to buy those bonds were now on his case for buying those bonds. So it's a thankless job. So, you can try to get more yield. You can change your haircut, but the haircut is what it is. So, if you expect $100 in losses every year, that's not going to work. Now, we said, really he needs 7 basis points. So we could do 7 basis points. That still doesn't get you what you need. So it's just not material enough. It's not going to help you. You can reduce your crediting rate to say like 4.4% or 4.5, even 4.6. 4.6. So instead of 4.7, you reduce it to 4.6, and that would get you there. But that 4.6 might put you in the top 35% instead of the top 25%. So you're not where you want to be competitively. If you can cut expenses, cut expenses. You could change your capital charge. Instead of taking 1.5, you could say, let's just take 1.3. 1.2. 1.3 would probably do it. So even 1.25 or 1.35, 1.4 might even do it. Yeah, 1.4, you can see they can make 15%. But they might get downgraded because they may need 1.4 if they are a single A rated or triple B rated insurance company, and they change their RBC target from 1.5 to 1.4, they're going to be downgraded by the rating agencies. And so that would be an issue. So you can see as we go through that list, none of those are really good answers. Expenses is the only good answer, but on expenses, you should be doing that all. You're not sitting around wasting money and saying, oh, we're not meeting our targets, let's start cutting these bad expenses. No, you need to be doing that all the time. So that's the first problem. We'll work on another one of these, and what I'll do for the next class is I will give you an example problem, and you can freeze the video. I'll take one from the last exam. You can freeze the video, work it yourself, and then watch me walk through these solutions so you can get some good practice on it.